My name is Karin Kaz and I'm going to discuss question 2 with you. Question 2 counts 40 marks and you have 48 minutes to complete this question. There is a part A and a part B, but we are going to start with part A. First of all, before we look at the question, let me just take you to the required portion so that we know what is required of us in the question. You will see that I've highlighted everything beforehand just to make it easier for time. The required portion says, calculate the tax liability of Drum Rum Pty Limited for the year of assessment ending 28 February 2014. And this counts 35 marks. Now we go to the question and we read the information given. Drum Rum Pty Limited is not a small business corporation as defined and carries on business as a liquor manufacturer. The company operates mainly in South Africa and sells most of its liquor products on credit to liquor retailers in South Africa and neighboring countries. The company is a registered vendor for VAT purposes and its year of assessment ends on 28 February 2014. All amounts exclude VAT unless otherwise stated. The company has a taxable income of 6758631 before the following information has been taken into account. Now, before we start with anything, I've made a little mind map for you just to tell you what all the important information is to know. First of all, we know that the year of assessment is 28 February 2014. This is a VAT vendor, so we know that there will be VAT implications. It is not a small business corporation, therefore we are going to use the 28% rate that is applicable for companies and closed corporations. Now, if it's not a small business corporation, you know that for non-manufacturing assets, we use the Section 11E allowance, and this is dictated by the binding General Rule 7, which gives you the write-off periods. For manufacturing assets, we use Section 12C, and for new assets, we use 40%, you get an allowance of 40% in the first year and 20% in the following 3 years. For used manufacturing assets, you get an allowance of 20% for 5 years. So this is just to sum up the information given to you in the first part. Now we move on and we start completing the question. So we first write down our taxable income. Which is 6758631. And we go to the first item. Export sales, cash, 750,352 Rand. Now, it doesn't matter if it's cash or credit. This is an income, so we say sales, cash. This is included in your taxable income. Next item, let me number this for you to make sure you follow. Item number 2, dividends received, South African companies. Now you'll see that I've highlighted the part that says South African companies because we know that local dividends are exempt from tax. So we say item number 2, dividends, local, and we say they are null, which is exempt. Item number 3, imported liquor ingredients used in the manufacturing process. Now we know that this is a manufacturing company, therefore this amount will be deducted from your taxable income as it is part of your manufacturing, and we say imported liquor ingredients, or we just say imported ingredients. And the amount is 588,535, and we deduct that from your taxable income. Item number 4, for opening and closing stock, we always use the lowest of cost or market value. Remember that opening stock will be deducted from taxable income, and your closing stock increases your profit, therefore we will add that to your taxable income. So if we look at note number 4, the inventory at cost as at 1 March 2013 was 291,250, and the market value at March 2013 was 289,750. So we are going to use the lowest amount. Therefore, we say your opening stock will be 289,750, and this will be deducted from your taxable income. Note number 5 will then be your closing stock, and we do exactly the same, the lowest of the cost or market value. So the cost at 28 February 2014 was 319,760, and the market value at 28 February 2014 was 325,753. So we use the lowest amount. And we say closing stock. And we add this to your taxable income is 319,760. Just remember that this will be your lowest of market value or cost. And I forgot to mention, although I said that the local dividends are exempt, just write this as a reason for yourself because you also get marked for this. Let's go on to point number 6. Bad debts written off during the 2014 year of assessment. Now we know that bad debts, we can deduct the full amount from your taxable income, and we say bad debts, and the amount is 75,205, and we deduct that from your taxable income. Note number 7, item number 7, is your list of doubtful debts, and they give you for the previous year and for this year. Now remember, for this year, you can deduct 25% of the list of doubtful debts, and the amount of the previous year, you also take 25%, but you add that back to your taxable income. And this is an important note, if they give you the allowance that has been claimed in the previous year, you will add that full amount to this year, and you don't apply the 25%. So that's important to note. So for this year, which is the list of doubtful debts at 28 February 2014, we are going to deduct this 25% of this amount. So we say doubtful debts, and we take the amount of 105,250, and we multiply that by 25%, and that will give you 26313 that you deduct from this year. Your list of doubtful debts for the previous year, you will have to add to taxable income. Remember, this is your current year and this is your previous year. And that amount will be 85725 times your 25%. And that will give you an amount of 21431 that you will add to your taxable income. And we move on to the next item. Item number 9 is your personnel costs. Incentive bonuses to all employees, this amount is fully deductible as it is in the production of income, so we say incentive bonuses. And we deduct, 350,000 rand. Contributions to the pension fund on behalf of employees. The Commissioner has approved a remuneration of 2 million for the purposes of pension fund contributions. Now, this is not said in vain. We know that you are only allowed to deduct 10% of the amount that has been approved by the Commissioner. Therefore, we will have to apply the 10% to the 2 million, and we say pension fund contributions and that will be 2 million times 10%, which will give you 200,000, but this is only limited to the actual amount that has been paid. So therefore, the amount of 135,250 will be deducted. But you have to put this limitation because we give you marks for this. Let's move on to item number 10, which is your legal costs. Now remember, legal costs is deductible if it's in the production of income. If not, or if it's for a private issue, then it's not deductible. So in this case, we say legal costs relating to collecting outstanding debtors. This is deductible because it's in the production of income. And we can say legal costs, debtors. So that amount is fully deductible from your taxable income. If we go to the next one, legal costs paid on behalf of one of the company's directors regarding a private issue. You'll see that I've highlighted the private issue. This will not be deductible. Private, so this is specifically prohibited. And you can write this as well because we give you marks for this. And we have to say no, just to show. Item number 11, advertising costs incurred. Cost of advertising a vacant post in the weekly Cape Mail. Now this amount is going to be deductible as well, as it is a recurring expense. However, if something is a once-off expense and it creates an enduring benefit, which we'll see in the second scenario, then that is something that is not deductible. So for the first one, it's going to be deductible, and we say advertising. And it's for the week in the, let's say it's a recurring expense, so therefore it's deductible, and we say it's 4580. However, if we look at the second one, cost of erecting a billboard close to the BR International Airport in Botswana, this is a once-off expense, capital in nature, and will not be deductible. So we say that the billboard will therefore be capital and not deductible. No. Now we have done most of the income and the expenses, and we move along to the capital assets. Point number 12. Drum Rum Pty Limited purchased the following capital assets. A new brewing manufacturing machine B was purchased on 31 December 2013 at a total cost of 350,000 Rand and was brought into use on the same date. Installation costs for machine B amounted to 14250, including VAT. This is important because we know that we have to first exclude the VAT amount, add that installation cost to the cost of the new brewing machine, and then we can apply the capital allowance. Therefore, we say, let's say machine B, and the cost of the machine is 350,000 Rand. The installation costs will be your 14250, and we take out the VAT amount, which will give you 12,500 Rand. And if we add that together, you get an amount of 362,500 Rand. And that will be the amount that you use for your Section 12C capital allowance. So now we can say capital allowance. And remember, this is a new machine. And as I've showed you in the beginning, when I showed you the information, we are going to use the 40% because it was brought into use in the same year. So we will say 362,500 times your 40%, and that gives you an amount of 145,000 Rand. That is deductible for the current year. Let's now look at the second part of item number 12. A second-hand delivery vehicle was purchased on 30 June 2013 at a total cost of 125,000 Rand to deliver the liquor products of Drum Rum Pty Limited to its clients. Owing to technical problems, the delivery vehicle was only brought into use on 1 September 2013. Now this is important to note because we are going to use the Section 11E allowance, and we have to apportion that amount in the period which it was in use during the current year of assessment. So we move along, we say second-hand vehicle. And we take the amount of 125,000. We now need the rate to determine what the write-off period is for second-hand vehicles. So if it is not mentioned in the question that you are busy with, make sure it's not mentioned anywhere else in the question as additional information. And in this instance, you will see under note number 18, additional information, general binding ruling number 7 allows for the following write-off periods for movable assets, delivery vehicles 4 years. So we know that this will be written off in over 4 years, so we divide it by the 4 years. And remember, we have to apportion this amount from 1 September 2013 to 28 February 2014, which is 6 months. And that amount that we can deduct will then be 15625. And the last portion of question number 12. A new manufacturing building was erected on 30 April 2009 and brought into use on 31 July 2009 at a total cost of 1650000. The building houses the whole liquor manufacturing process of Drum Rum Pty Limited. A new manufacturing building qualifies for your section 13(1) building allowance, which is 5% of the amount. So we say new building, manufacturing building. And this amount will qualify, the 1650000 will qualify for the 5% allowance. Which is 82,500 Rand. And we are finished with note number 12. We move on to note number 13, item number 13. I'm first going to read item number 13. This is very important and students tend to find this very difficult. But if you see what I've done, you will see that it's actually very easy. This is your leasehold improvements, the lease premium and your rental. So there's 3 components to this question. Let's first read everything, highlight the important stuff, and I'll show you on the timeline that it's actually very easy. Drum Rum Pty Limited received a sudden demand for one of its flagship products and was forced to look for additional manufacturing space. Bliss CC was approached and a lease agreement was signed on 1 July 2013 with a monthly rental payable of 15,000 Rand as from 1 July 2013 for a period of 5 years with the option to extend the lease period for another 5 years. The lease agreement stipulated that Drum Rum Pty Limited had to make leasehold improvements of at least 550,000 Rand and had to pay a lease premium of 90,000 Rand. The lease premium was paid on 1 July 2013 and the leasehold improvements commenced on 1 August 2013 and were completed on 1 December 2013. The total cost of the leasehold improvements was 600,000 Rand and the improvements was brought into use on 1 January 2014. So you know that there's now a lot of information. We break this up into different sections and you'll see it's not that difficult. First of all, we go to the rental. That's the easiest part. We say that they have received a monthly rental of 15,000 Rand as from 1 July 2013. So if we write down the rental received, paid. Sorry, I made a mistake. They paid the rental amount, not they didn't receive it. It was payable of 15. It's going to be 15,000 Rand and then 8 months, which is from 1 July 2013 to 28 February 2014. Now, before I go on to anything else, I'm going to show you the timeline for the leasehold, for the lease premium and the leasehold improvements. You will see that I've written down lease premium paid 1 July 2013. Leasehold improvement commenced 1 August 2013. Leasehold improvement completed 1 December 2013. Leasehold improvement brought into use 1 January 2014 and your year of assessment is 28 February 2014. The lease was for 5 years and you have the option to extend it for another 5 years, which will then be until 30 June 2023. So for the lease premium, we take the amount we divide it by the original lease, which is 5 years, plus your option to extend, which is another 5 years. And then we multiply that by the period in which the asset was in use. Now for the lease premium, this was in use from 1 July till the end of your year of assessment. So I'm just going to highlight this in yellow, which will be your 8 months. So therefore, if we write this down, it's going to be your lease premium and we say it is the amount, which is the 90,000 Rand, divided by the original lease period plus your option to extend. Now, what you can do is you can write 10 years or you can write 120 months. It's easier to do it in months because then you won't make a mistake. For me, that's in any case the easiest. So you divide it by 120 and then you multiply it by the period that the asset was in use, which is your 8 months. And then you get an amount of 6,000 Rand that is deductible. I didn't write the amount of the 15,000. Let me just make sure. That was 120,000. And that's your lease premium. If we go on to the leasehold, now as I said, you can also say alternatively 90,000 divided by the 10 years and then you multiply that by 8/12. You can decide what is easiest for you. Then we move on to the leasehold improvement. And let me just show you again. The leasehold improvement will be the lesser of your contract amount or your actual cost. So in this case, it's going to be the 550,000 Rand and not your 600,000 Rand. Okay? Then you divide that by your original lease period, which is the 5 years, plus your option to extend, which is the other 5 years, less your commencement to date of completion. So in other words, your leasehold improvement commenced on 1 August 2013 and it was completed on 1 December 2013. So that will be 5 months. So you deduct the 5 months. And you also multiply it by the period that the asset was in use. And in this case, it was brought into use on 1 January 2014 until the end of your year of assessment, which will be 2 months. So if we write it down, it's going to be remember the lesser amount, so it's the 550,000 Rand. And we divide that by your original lease plus the 5 years is 10 years, 120 months. Less the 5 months that I've shown you, and then you multiply that again by the period that the asset was in use, which is your 2 months. And your amount will be 9,565. And if you want to do this in years, you can again say the 10 years, and then, but make sure that you do this calculation correctly, because the amount will then, you have to divide it by 9.583 and you times it by 2/12. And that is this question. It's not that difficult. And remember, because there is a difference in the actual cost and the contract amount, the 600 and the 550, we will also get a building allowance on this amount. So we can say building allowance we take the 600,000 and we deduct the 550,000 from this amount, and that we multiply by 5%, and that will give you an amount of 2,500 Rand that you can deduct. And we are finished with item number 13. Let's go to item number 14. Drum Rum Pty Limited sold a technologically outdated manufacturing machine on 1 February 2014 for 15,000 Rand. It was originally bought second-hand on 30 April 2011 for 100,000 Rand and brought into use on the same day. The company has elected a Section 11O scrapping allowance. Now, in this instance, they tell you that the company has elected the Section 11E allowance, and remember, if the tax value is more than the proceeds, then you will get a scrapping allowance. So we start off by saying that it was a manufacturing machine, and we put manufacturing machine at the cost. And the cost of your machine was 100,000 rand. Remember that your Section 12C allowance can never be apportioned. So if we look at the first date, this was bought originally on 30 April 2011. So for your 2012 year of assessment, your amount is going to be the 100,000 multiplied by 20%. And the reason why this is 20% is because it is a second-hand machine. And your first allowance for the first year is going to be 20,000, and we have to do it until the current year of assessment. So for the 2013 year of assessment, it's going to be the same, times your 20%, it's again 20,000. And for the current year of assessment, it's going to be the same, 100,000 times your 20%, because remember this, the 20% is for 5 years. And because this is the current year of assessment, you must also deduct this from your taxable income, because this is the allowance for your current year. Now, if you deduct all of the amounts, you will get a total of 40,000 rand. And now we just make sure what your proceeds were. The proceeds were 15,000. And if we deduct that, we get an amount of 25,000 rand, which is your scrapping allowance. And this amount you will deduct from your current year of assessment, from the taxable income. And that is done with item number 14. Then we move on to item number 15. The following costs were incurred relating to patents and trademarks. Renewal of patent J on 1 August 2013 is 9,000 rand. Purchase a new trademark on 31 December 2013 is 65,000 rand. Now we know that a renewal of a patent is always deductible. However, if you purchase a new trademark, this is not deductible. But you have to go back to your study material to make sure you know what's the difference. So your renewal of patent J will be deductible. That is your 9,000 rand. But your trademark will be prohibited and not deductible. And that's no. And that's item number 15. Then we move on to item number 16. Drum Rum Pty Limited entered into an agreement with Label Brew, the former brewmaster, on 31 December 2013, the date on which he resigned, and paid him an amount of 580,000 rand as a restraint of trade payment for a period of 5 years. The agreement was effective from 1 January 2014, and the 580,000 rand was paid on 15 January 2014. Only 550,000 rand of which was taxable in the hands of Label Brew for the 2014 year of assessment. Now, for a restraint of trade payment, we also, in this scenario, we are going to use the 550,000 rand because that's the amount that he was taxed on. So you cannot use the 580,000. So therefore, we say the restraint of trade payment is going to be 550,000, and this we are going to divide by the years in which the restraint was effective, or otherwise a third of the cost incurred. So we say 550,000 divided by the 5 years in which the restraint was effective, or, and remember it's the lesser of the two, or it's going to be the 550,000 divided by 3. And this is 110,000, and 183,333. So the lesser of the two amounts is the 110,000, which you can deduct. And we are almost done with the question. Item number 17 is your donation. Drum Rum Pty Limited donated 50,000 Rand on 18 December 2013 to Men in Orange, a public benefit organisation, and received a Section 18A income tax certificate on 31 January 2014. Now, before you do a donation, you have to calculate your subtotal, because a donation, the amount of the donation that you can deduct from your taxable income is limited to the 10% of your taxable income. So if we calculate the subtotal, your amount is 5837031, and the donation that we can deduct will be limited to 10% of the taxable income, which is the 5837031, and that will be 583,703. However, if you haven't made this much donation, so you can only deduct the actual amount of the 50,000. But many students never show this calculation, and then they lose marks. So make sure that you show the calculation, because you give you the mark for the 10% and then the taxable limited to the subtotal. And we deduct the 50,000 Rand. We are now going to discuss the very last item, which is item number 18. And remember that we have already done the first part, so we must just make sure that there's nothing else extra that we miss. In this instance, we have to read what it says. The company has an assessed loss brought forward from the 2013 year of assessment of 112,000 Rand, 112,314 Rand. Now, if we move on to item number 18, remember that your assessed loss is always your very last item before you calculate your taxable income. So we say assessed loss, and this is allowed as a deduction in the current year of assessment, is 112,314. And there's another bit that we have to read. The company had also paid provisional tax of 1,351,584 for the 2014 year of assessment. So we have to do the provisional tax calculation as well. Before we do that, we work out what the taxable income was. And that amount is 5,664,536. And now we have to work out our tax, which is at 28%. And that will be 1,586,070. And now we can deduct the provisional payment that was already made during the year of assessment. Provisional payment. And we have given this amount to you. It's 1,351,584. And this will give you the tax liability of 234,486. And if you just make 100% sure, that is what was required of us to calculate the tax liability, and now we know that we can finish this one off. So now the last part of this question is going to be your part B. Part B is your dividends tax question. This is a very easy question. Let's quickly go through it and you'll see how easy it is. This is 5 marks and you have 6 minutes to complete it. Buildings Limited, a resident company, declared a dividend of 850,000 Rand on 15 February 2014. The shareholders comprise of Alex Barnard, which is a natural person, and it's 25%, and then also Roofs Limited, which is a listed resident company, and he has 75%. The contributed tax capital is 3.6 million. The company has an unutilized STC credit of 100,000 Rand carried forward from the dividend cycle that ended immediately before the effective date. If we look at the required section, that we ask calculate the net dividend received by each shareholder after the dividends tax was deducted, and this is 5 marks. So first of all, we have to determine what the dividend was that was declared. So the dividend declared was your 850,000 Rand. However, we told you that there was an unutilized STC credit of 100,000 Rand, and this amount we are going to deduct from your dividend declared. So we say less your STC credit, which is 100,000 Rand. And this is now the amount of dividends that is subject to dividends tax, the 750,000. Now we go on to each shareholder. The first one is Alex Barnard. He is a natural person, and he will then be subject to dividends tax. So he has 25%. So we're going to say the dividend portion, therefore, will be the 750,000 Rand times the 25%, and that will give him a dividend of 187,500. Your dividends tax is calculated at 15%. Dividends tax, so we will multiply that amount, the 187,500 by the 15%, and that will give you 28,125. And if we deduct that amount from your dividend portion, it's going to be 159,375. And remember that that is then your net dividend received, which is the required portion. The next one is Roofs Limited. And this is a listed resident company, and we know if you go through all of your theory for dividends tax, you know that they are exempt from dividends tax. So therefore the dividend portion for them is going to be the 750,000 times the 75%, which is 562,500. And the dividends tax that we are going to deduct is null because they are exempt. So we write exempt, so it's null. So therefore, the net dividend that they will have received is going to be the 562,500, and we say that that will be your net dividend. And that is the last part of the question. This is a very long question. Make sure that you know when to apply which capital allowance, when it's applicable for which expense to be deductible. This is very important for the exam. And I hope that you do very well and you pass with flying colors.